My name is Sharan, and I've spent a few years in finance. And the one thing that I've realized is that how deeply fear influences how we spend money and how we save money. So, there are two types of people: the ones who barely save any money, who are constantly spending on new gadgets, new experiences, and then they later regret all those purchases that they've made. And on the other hand, we have people who are constantly saving money and yet they feel anxious and terrified about the future. Let's get into it one by one. The first group of people, let's call them the overconsumers. Now, this behavior of overconsumption is often stemmed by the fear of missing out. Whenever someone wants to buy something, the idea is that when I buy this product or the experience, I'll finally be happy and I'll not be restless. But let's be honest with ourselves and ask that whenever we have succeeded in buying a product or an experience, how quickly have we jumped onto another thing, another product, or a new experience? For example, if I want to buy an Apple Watch, I get a bonus at my job and I use that money to buy the Apple Watch, thinking that it will make me content and fulfilled. But the question here to ask is that how long does that feeling last? A day, a week, a month, and then it fades away. Now, I'm not saying that buying stuff or consuming stuff is a bad thing, but hurting ourselves financially for a thing which won't fulfill us as much as we believe it would is a really bad decision. On the other hand, people make the mistake of bringing down their spending to zero and saving everything and anything for the future. It's like delaying gratification but till when? You wanted to go on that trip, but you didn't. You were saving money. You wanted to buy that dress, but you didn't. You were saving money. You wanted to buy that car, but you didn't. You were saving money. And now you have a lot of money saved up and you can finally enjoy that. Or maybe you can't. The idea to constantly save money also stems from fear. The fear of what if something goes wrong tomorrow? What if I don't have enough for tomorrow? Now, I'm not going to tell you that how much you should spend or how much you should save, but one really useful filter that I can suggest is that whenever you have a desire to spend or save, question that desire arising within you, is it truly yours or is it manufactured by some industry or advertising or some social pressures around you? In this way, you won't be spending on 1,000 things which are sold to you, but you will spend only on those things which you truly want, and these purchases won't end up making you feel guilty later. So both these fears of spending and saving money are driven by fear, and these behaviors extrapolate into our investment journey as well. We either end up picking too risky assets just to get a higher rate of return, or we end up picking very safe assets just so that we don't lose money. So the way out is to have a strong overall asset allocation which helps us build wealth over a long period of time. A strong asset allocation not only makes you feel good when the markets and the economy is in uptrend, but it also helps you feel safe and balanced when the markets and the economy are in a downtrend. Most of the mistakes that happen due to heightened emotions. Now, the idea is not to fight these emotions, but to have an asset allocation which helps us reduce the intensity of these emotions. Today, I want to talk about different type of asset classes which are out there, not on the basis of the returns that they generate for you, but on the basis of the risk that they cover for you. So first, let's try to list down what all do we actually need from our portfolio. Number 1, growth and wealth creation. Number 2, protection from inflation. Number 3, protection of our capital. Number 4, protection in times of emergencies. Number 5, some stability and balance. And number 6, emotional satisfaction. So let's start with cash and liquid savings. This includes the cash in your bank account or any other liquid fund which is easily accessible to you. The role of cash is to cover the risk of all the immediate uncertainties that you have in your life. For example, a job loss, some medical emergency, or any other kind of short-term uncertainty that you have in your life. Let's see this with an example. Suppose you lose your job due to some reason and don't have enough savings to take some time to find another job. Now in this case, you'll end up taking anything that comes to you. Maybe a job that you don't like, maybe a city that you don't want to go to, and this will end up making you feel frustrated and unhappy for at least a few years. But on the other hand, if you have an emergency fund which covers 9 months of your expenses, you can take 4 to 6 months to find a job that you really like and which suits you. So an emergency fund basically buys you breathing space so that you can take decisions in your life more logically and rationally rather than emotionally. So let's see what cash covers for us from a checklist. It provides protection to our capital, it provides protection for emergencies, and it also provides some level of stability and balance. So the next asset class is equities. This is the asset class which helps you the most in building wealth over a long period of time. So what is equities? It's basically you owning a part of the business. Let's understand this with an example. Suppose your friend has a kirana shop and you want to take part in his business. You give him 100 rupees and you now own 20% of the business. Now whether your 100 rupees grow or not depends on how well does the kirana store do. So if the kirana store does well, your 100 can grow to 150, and if your kirana store doesn't do well, your 100 can also reduce to 50. This is called having equity in a business. Equity mutual funds, stocks, all fall under this category. The problem with stocks is that you can see the price of the stock every day. Yes, this is a problem. I'll explain how. So the price of the kirana store moves daily, not only on the basis of how well the kirana store is doing, but also on the basis of the fear, greed, and news around the kirana store. Whereas the actual performance of the kirana store depends on whether the store is able to consistently increase sales and expand over time. So it is important for you to commit significant amount of time to this asset class to reap the benefits of it. Let's see what equities cover for us from our checklist. It provides us with growth and wealth creation and some protection against inflation as well. So the next asset class is fixed income. As the name suggests, this asset class provides us a fixed rate of return over a period of time. Going back to the kirana example, in this case, you receive a fixed interest from your friend each year, and after a defined period of time, you get back your 100 rupees. Your initial capital of 100 rupees is safe. It neither increases nor decreases. Your FDs, debt mutual funds, government securities all fall under this category. So I have always seen a lot of people shaming this asset class for the mediocre returns that it provides, but I think there is more to it. Let's take an example. If we have two portfolios, portfolio A is completely comprised of equity and portfolio B has 70% equity and 30% debt. So in a year where the equity markets fall by 10%, the portfolio A will lose 10 rupees on the equity portion and neither gain or lose anything on the debt portion as it doesn't have one. So the net return on portfolio A will be minus 10%. On the other hand, the portfolio B will lose 7 rupees on the equity portion of the portfolio, but at the same time gain 2.1 rupees on the debt portion of the portfolio. So the net loss on portfolio B would be just 4.9 rupees, which is 4.9% on the portfolio. This is an outperformance of 5.1%. I want you to look at this 5.1% as a cushion to our portfolio. So yes, in the long run, a pure equity portfolio might surely outperform a portfolio which has some mixture of debt. When you have a mixture of debt in your portfolio, you get multiple benefits. When the markets are in a bull run, you get to enjoy the equity bull run as well as the fixed rate of return on your debt portion. And when the markets are in a downtrend, your debt portion helps you cushion the hit that you take from your equity portion. This provides stability and balance and reduces volatility and the heightened emotions in your mind, which in turn helps you take more logical and rational decisions. Let's see what fixed income covers for us from a checklist. It provides protection to our capital, it provides stability and balance, and it also provides some level of protection against inflation. So the next asset class is precious metal. This includes gold and silver. The major risk that this asset class covers for us is that it is very closely linked to inflation. For example, 20 to 30 years ago, a few hundred grams of gold could fund a meaningful down payment of a decent house. Even today, a few hundred grams of gold can still fund a meaningful down payment of a decent house. So in this way, our purchasing power is preserved. Another risk which gold covers for us is the systematic risk. Basically, in times of stress, for example, wars, geopolitical tensions, climate calamities, gold acts as a shield. Basically, if everyone is toasted and the trust in the system reduces, the trust in gold increases. Let's see what does gold cover for us from our checklist. So it protects us from inflation, and for longer time horizons, it also protects our capital. So the last asset class is real estate. I think real estate is the most trickiest asset class, especially in a country like India, where real estate is not looked at as a financial purchase but more as an emotional and a social purchase. We see so many people who take up huge loans to buy houses which they really can't afford, but they still do that under social pressure and the need for validation. Another mistake which people do is increase their loan tenure just so that they can fit the EMI in their monthly budget. So the longer the loan tenure, the lesser your EMI will be. So if you are 30 and you want to buy a house, just to fit in your EMI in your monthly budget, you end up taking a loan for 35 years. Now this has some real risks. You will have to work for 35 years just to get this loan off your shoulders. You cannot really take any risk that you want, not in your job, not in your business, because you have a hanging sword over your head. This really messes up the overall portfolio allocation and makes the financial journey very difficult. But still, let's see what all does real estate cover for us from our checklist. So it surely provides us emotional satisfaction, it protects us against inflation, and in some ways it also protects our capital. So seeing our checklist, we can observe that each asset class has their own role to play in our life, not just in generating returns and creating wealth, but also helping us manage different fears and risks in our life. The key is not to avoid any asset class, but to find the right mix of assets which suits us depending on where we currently stand in life. In the next video, I'll go in detail regarding these asset classes and we'll discuss them and we'll try to use as fewer numbers as possible. Thanks for listening.